All right, welcome everyone. Thank you for attending on another episode of our Zoom podcast. My name is Seewing from the Real Estate Network, and my co-presenter is Maureen McCann from Spartan Invest.com. And thank you for being here, Maureen.
Thank you for your leadership, Seewing. You're the one that's the leader of this, the power train of this. I'm just kind of hitching my wagon onto you. So let's do it. Let's roll.
Oh, you're doing much more than that. All right, thank you for attending. Anyway, today's topic, we can talk about how to use your self-directed IRA to buy investment properties. All right, so with that in mind, let me share my screen here. And once again, before we start this, our disclaimer is such that Maureen and I, we are not a licensed tax advisor. We are not a licensed financial advisor. This presentation is only for educational purposes. For each one of you out there, you need to consult with your own licensed tax advisor or financial advisor to go over your unique financial goals and objectives and your risk tolerance, because any kind of investment is subject to risk, the risk of loss of principal and other risks associated with investing. So thank you and for attending. And with that in mind, let's talk about how to use your self-directed IRAs to buy investment properties. And before we begin, we always start this off by sharing with the audience out there that for those of you risk investors, especially newbies out there, and some of your experienced investors, you still does not have a total concept on the value of owning rental properties and the responsibilities associated with owning rental properties is more than just having the money to invest. Because if you have the mindset to invest for the long term, real estate will be good for you. Okay, so income property is history's most powerful and proven and the most attractive, multidimensional and most tax favored asset class in history, greater than any other asset class, crypto, Bitcoin, stocks and bonds, mutual funds, or whatever, because there are 5 dimensions of real estate properties. You get passive income, cash flow, you get tax benefit depreciation, which we can talk about, and equity growth, appreciation, and then the power of using a leverage, using financing and getting a 30-year fixed rate mortgage, right? So with that in mind, something that myself, within my organization, as well as Maureen, we've been directly involved with our team to assist many of our risk investors to buy investment properties in the name or the IRA, self-directed IRA. So, am I right, Maureen?
This is how I got started, because I had no money outside of my, this was whatever, 15 years ago. Didn't really have a lot of capital outside of my retirement accounts. And I had heard about this real estate investing thing, and I watched a buddy of mine do it. And I kind of kept checking in with Randy to see if he was making money, and he was. And so I was like, well, I want to do this too. I don't have any capital, disposable capital outside of my, besides my retirement accounts. And that's how I learned about the self-directed IRA. I self-directed my funds. And I've got properties in my self-directed IRAs that are produced. They're paid off now, and they're just filling that account every month.
Of course, yeah, very good to know. And of course, you and I, in the course of our daily business in the real estate consulting world, we've been helping many real estate investors to buy hard asset income property through their IRAs. Yep. Right? Having said that, what I've found over the years is that the use of self-directed IRA has been very underutilized, meaning there are still the majority of real estate investors out there who still do not understand the value and the benefits of buying income property using their retirement account, their IRAs. Am I right, Maureen?
It is very underutilized, 100% true.
Well, again, I don't want to make this presentation too long, but I could say one of the main reasons is the Wall Street, and those stock market investors, they are keeping investors at their place. They're not educating investors. They brainwash the U.S. citizen into thinking there's only one way to invest, which is through the stock market, because those stockbrokers, those financial advisors working in Wall Street get paid commissions and asset under management. Any investors out there that can pull their money out of the 401k, out of the stock market, and out of the mutual funds into a self-directed IRA vehicle to buy real estate, those Wall Street, they will not make any money.
Their income goes down. They don't want their income to go down. They want it to go up. So they want you to keep putting more money into the products that they sell, because that's how they earn their commissions. So they're going to tell you, just like when I wanted to do this, same thing. I got the same messaging, and I got all the scare tactics of you're going to lose on compounding. You're going to pay the fund, this, that, and the other. And I was like, I ignored what they said because I just listened to the facts. I did some research and I understood that, okay, yep, this is something that I can do and I want to do, because at that time when I had made that decision, my, you get your monthly statement on how your investments are performing. And leading up to that time, it was doing really good, right? I had all these, it was like my money was making money for me. And then it wasn't, right? And I kept seeing my statements of, in the red with the negative in front of it, that I was losing money. And I just happened to attend a webinar or a seminar at that time. And that's when I learned about the self-directed IRA. And I thought, I'm going to try this. I'm just going to move my money out of a 401k that I had not rolled over from another company. I rolled it into a self-directed IRA company, a trust company. And then I was able to direct, that's what it's called. I was able to direct my investments. I wasn't relying on someone else to tell me what to do or where my money was going and paying them a commission. I was doing the transaction myself, but through my IRA. So like you take the money out of the IRA, that's a taxable event. You keep it in the IRA and you direct the IRA to tell them what you want to invest in.
Yep, exactly. It's a lot simpler than people let to believe. So again, it's all about brainwashing by Wall Street over the years. They're keeping trillions of dollars of retirement money in their coffin and not educating their clients that they can use IRA money to buy real estate. So anyway, it's a conspiracy. So that's enough of that. Let's inspire our investors. So all of you wannabe investors out there, you have previous employer 401ks. You have traditional IRAs sitting everywhere, like Charles Schwab, Fidelity, wherever in the previous employer 401k. And yeah, you're investing very passively, right? Mutual funds are so easy, right? You don't even do anything, and hopefully you make money. So it's very, very passive. That's why your returns are so low, because mutual funds and stock and bonds are, for the most part, is a very passive investment, because you as an investor will do nothing. You don't even need to read the prospectus. You just put a lot of money and hope for the best, and hopefully the portfolio manager will do what's to your best interest, which does not happen all the time. So anyway, enough said. So if you're motivated to buy investment property after hearing from this presentation, your first step is identify where is all your money, all your retirement accounts has gone, right? And the only money you cannot convert into a self-directed IRA for the most part is your current employer 401k, right? As long as you're working for your current employer, you cannot self-direct those money outside your 401k until and unless you quit that employer. Then after that, you can roll the money over into a self-directed IRA. Again, if you have a lot of traditional IRAs sitting everywhere, some people I know have 3 or 5, 6, 7 accounts with different companies sitting there earning low return because because that's the way it is. So you have the ability to here's the first resource we have. I know there are many. You have to go to a third-party custodial IRA company that can help you facilitate with the transfer, right? So this company that I use, I don't know, Maureen, your organization have your own people you recommend for the IRA custodialship, which is fine. I use Karen Hall and a couple of others. So that's her information. So the first thing you do is contact this company. They can help you facilitate transfer of your previous employer 401k, your IRAs, do a tax-free transfer from one bucket of paper into another, into a self-directed IRA. Then after you facilitate the self-directed IRA, you can use the name or your self-directed IRA to purchase rental property in the name of the IRA. One more thing that people they don't understand, and I'm also going to talk about the non-recourse loan momentarily. It's kind of hard to understand, but I will use the KISS method to try to explain to you. Keep it simple, stupid, KISS, KISS method. I will do my best. Another resource that I have, I do not know any other true, real, legitimate non-recourse lender that could leverage your IRA. You can, now this is a little bit advanced strategy, Maureen, is that you can use your same self-directed IRA and use a non-recourse loan to stretch your IRA to buy more properties. Mm-hmm. Does that make sense?
That's what I did. Yes.
Good. Yep. You and I get it. And most people, they need to be educated, and we're doing our best right now. I will talk more about non-recourse loan momentarily, but let's go through let's go through a real case example. Okay. So let's say you identify a property that you want to buy in Rossville, Georgia. Does this property rings a bell? 192,000 Maureen?
It does, and I just sold that one this morning.
Good for you. Wow, you are on the roll. On the roll. The drum roll, please. Okay, let's use this real case example. Investor, they want to use the IRA to purchase this particular single-family home property located in Roseville, Georgia, good turnkey property with third-party management through Spartan Invest.
Thanks for the plug.
192. So this investor using the company I just showed you, the self-directed IRA company, iDirect, what's the name? UDirect IRA Services. And you transfer the money over from your IRAs or previous employer 401k around, let's say, $200,000. You need some cash reserve also. So in the name of the IRA, you can buy this property, all cash, all IRA. Very simple, right? All cash. So, then you buy in the name of the IRA, okay? Not under your name, okay? People need to distinguish that. I know it's your money. I know it's your physically your money, but technically speaking, it's the name of the IRA, right?
So it would look like this, because I know this really well, right? So it would say the name of the trust company. So UDirect, or in my case, Equity Trust, right? So it's Equity Trust Company for the benefit of your name, and then the account number.
Yep.
That's how it's titled.
Yep. That's the official title.
Yes.
Equity Trust or UDirect FBO for the benefit of then your name.
Your name, exactly.
Yep. Let's say you're able to buy this property using your IRA. You close escrow, okay, all cash. So this is the numbers is just an example. Okay, you can use any other properties out there in the country, but so what's going to happen? Let's look at the numbers. So you bought this property, you close escrow inside the IRA, and you put $195,000, and you need some cash. You need some IRA cash reserve to factor in maintenance and potential vacancy, maybe another 15 grand, right, inside the IRA account, right?
And here's why, because you cannot mix personal money with IRA money. So if there is you need to cover a cost or for a repair or a vacancy, you just can't write a check and send it to the property management company. You're mixing funds. You cannot do that. You have to have the reserves in your account for such costs that could come up.
Exactly. So therefore, assuming on a monthly basis, your rent is $1,450 minus the taxes, insurance, property management fee, then your net income each month is a little bit more than $1,000. This $1,000 monthly money that's going to come to you via your property management. The property management will wire you this money into the IRA custodial account. This $1,035 monthly net cash flow is non-taxable. It goes into your IRA account every month. Okay, every month automatically. You do not report this money at the end of the year. There's no need to file a tax return because this is still an IRA. Is an IRS sanctioned portfolio using the IRS rules and guidelines. So at the end of the year, you have achieved net income of $12,427. Tax deferral. This money will be reinvested back inside the IRA. Okay? So when you file your federal 1040 every year, this amount is not taxable. Think about it. Okay, the wealth building vehicle associated by an IRA, if this $12,427 were a taxable event, for example, if you buy a rental property under your name, right, not under your IRA, if you're in a 25% federal tax bracket or 31% federal tax bracket, guess what? You can get a haircut. You have to pay taxes on this net annual income, right? So the beauty of buying real estate inside your IRA account is all your money goes tax deferred, and your appreciation every year is also, no tax event as long as you keep the property. Okay, so this is bear in mind, this is a long-term investment, because if you pull the money out prematurely, if you pull this monthly or annual income out, this cash flow income out of your IRA in which you bought the rental property in there, you'll be subject to early withdrawal penalty. If you pull it out before age 59.5, you're subject to 10% early withdrawal penalty on the amount that you pulled out on this cash flow income from the IRA. Furthermore, you have to pay ordinary taxation on the amount of the early withdrawal. If you're in a 31 federal tax bracket and 6% stick to California tax bracket, there's a 41% cut. In addition to 10% withdrawal penalty, another 10%, more than half, more than 50% of your withdrawal is be subject, you have to pay taxes on it. That is really bad. So therefore, anytime you buy an investment property using your IRA, it is a long-term investment. If you're age 30 right now and you're buying a property inside your IRA, you need to hold this property at least until age 59.5, right? So at age 59.5, at age 59.5 or older, you could liquidate the cash flow inside the IRA, but you have to pay ordinary taxes at that age. Maybe at that age, your income tax bracket is lower because you may not earn the full-time income, so you're subject to a lower tax bracket. At least you don't have to pay early withdrawal penalty, nothing like that. So once again, it's a long-term buy and hold investment. using an IRA, don't touch any of your money. Allow the cash flow to grow tax deferral. Allow the appreciation and everything else to grow tax deferral over time on the equity of your value of your property. And then when you reach 59.5, you may liquidate the monthly income to retire if you want. You do not have to liquidate exactly age 59.5. You can liquidate the monthly income, the IRA income at age 60 or age 63 or age 65. But another rule that the IRS have is that by age 72.5, I think that up the age, there's a RMD, there's a required minimum distribution when you have to liquidate your money to spend the money. You don't liquidate the IRA by the age using the RMD, required minimum distribution rule. Your IRS could hit you with some excise tax, which is about 50% penalty on the amount you invested. So that's the rule. All right. So
isn't there a rule though? I think that isn't that for a traditional account versus a Roth account? Would a Roth account be different?
Yeah, Roth account, right. If you invested your IRA using mostly a Roth account, you're not going to pay taxes upon liquidation at any time in the future. With the exception of if you withdraw the income before 59.5, then you will still have to pay 10% early withdrawal penalty. Yeah, but when after age 59.5, if you have a Roth IRA inside your rental property, wow, that's a beautiful thing. You don't pay taxes even when you withdraw the money. Now, Maureen, one more thing that people get very confused. Okay, what if somebody sell their investment property inside the IRA before age 59.5? What are the tax consequences on it? I will share that momentarily, unless you know the rule.
I haven't sold any of my properties inside my IRA, so I don't know.
Good for you. So again, I'm not a licensed tax advisor. It's just education. What if you sell your investment property, which you originally purchased with your IRA? If you sell the investment property before age 59.5 and spend the money for whatever reason and not buying another property for whatever reason, you're subject to ordinary taxation on the entire selling price. Does it make sense?
It does make sense. And I didn't know that. And it makes me angry at the government. And here's why: because you can't take some benefits like depreciation and things inside, or write off your expenses inside your IRA. But if you sold, so they won't allow you to do that. But if you sell it before then, the proceeds, I did not realize that the proceeds are taxed at ordinary income. They're good.
Don't quote me on that, right? Again, I'm not giving.
All right. I'm looking into it now.
Let me say this. Now, for people that want to sell your investment property before age 59.5 and not subject to ordinary taxation on the capital gains from the IRA selling of the property, the wise choice that you do is to reinvest those IRA capital gains to buy another investment property from those IRA money that you distributed from your sale.
Yeah.
If you do that, then you do not need to pay any taxes on ordinary income, tax bracket basis, or capital gain basis.
And that's because the money is staying inside the account versus coming out of the account.
Yeah. By tax rule, by reinvested, when you sell your rental property before age 59.5, and you receive the IRA proceeds on a closing transaction, as long as you immediately reallocate those IRA money into another IRA tax defer vehicle under the IRS rule, if you buy another rental property using the same IRA proceeds, I believe there are no tax consequences. Just like a 1031 tax-free exchange.
That's what I was thinking. Yep, exactly. Yeah. Okay.
Now, what if at age 59.5, or older, you sell that investment property outright, what are the tax consequences associated with that?
I don't know because I haven't sold. And I'm not 59 and a half yet, but I'm creeping up there.
Well, I don't have 100% clearly on the answer. If you sell it after age 59 and a half, let's think about this. You're not subject to 10% early withdrawal penalty, but I believe you have to pay taxes, right?
I'm looking.
Think about it. If you have a traditional IRA, and you sell the traditional IRA, which consists of stocks and mutual funds, after the age of 59 and a half, what are the tax consequences?
Know who to call to get that answer.
You have to call a licensed tax advisor. I have to consult with my tax advisor.
Yep, I know who to call to get that answer because that's a good. It's funny. I never really thought about that, Seewing, only because I've not sold any of the properties I have in my self-directed IRA accounts that will be relevant. And when and if I do, or my plan was just to kind of keep them there forever and just let them keep filling up my retirement account since they're both paid off at this point.
The key is just like, okay, your self-directed IRA inside the rental property, it's just like a traditional IRA inside a mutual fund portfolio. At age 59 and a half, ideally, you live off the income, you live off the cash flow.
Mm-hmm.
You just, at age 59 and a half, when you trigger the monthly retirement withdrawal from your rental property, i.e. the cash flow, that withdrawal is subject to ordinary taxation. We agree with that. But the only difference between taking your money out at retirement after age 59 and a half from your rental property and with IRA is that you don't have to pay 10% early withdrawal penalty. That's the only tax benefit you get between withdrawing the money, withdrawing this income right here, $1,000 per month. Before 59 and a half, you have to pay 10% early withdrawal money on the early withdrawal. Or if you draw income after age 59 and a half, no 10% early withdrawal penalty. You just pay the ordinary taxes on the amount of the withdrawal monthly. Does that make sense?
It does, but I think isn't there a difference though between the traditional IRA and the Roth IRA? Because isn't the Roth IRA the money's taxed going in but not out?
Right. Yes. Yeah. If you use all your Roth IRA to buy the property initially, you already pay taxes on the money coming in on Roth IRA.
Yes.
And if you hold the Roth IRA for at least 5-year holding period, if you withdraw the income in the future after age 59 and a half, no taxable event. You don't pay taxes on the amount you withdraw on the Roth IRA. But it's very hard for people to accumulate a large chunk of Roth IRA. You know that, right?
Mm-hmm.
Because most people have traditional IRA. Some people, they convert a traditional IRA into a Roth IRA, but the amount of the conversion is subject to ordinary taxation.
Tax. Yeah, that's true.
But if someone during that year and they don't have a working income, for example, have a part-time income, they're subject to a very, very low tax rate at 10 or 5% or 0% if they're not employed during that year of conversion. That might be a good year to convert your large chunk of IRA into a Roth IRA because you have no income to pay, to subject to pay the taxes on that year, right? Does that make sense?
Yes. Yep.
If you're in a high income tax bracket, it does not behoove you to convert your traditional IRA into a Roth IRA because you have to pay taxes on the year of conversion, right? Mm-hmm. Woo! I think too much technical stuff.
Well, you just I mean, it's funny because you just think of like we're thinking of investors and their questions, and these are the types of questions that come up. And this is where we say you definitely have got to consult your tax advisor on all these things. But I think it's a nice introduction to what the opportunities are if you do have money sitting in a retirement account and it's not earning you what you want it to earn you. then know that you have the option to basically roll those funds over. There's no cost to do that, to roll them over into a self-directed IRA account, which you then can direct on assets that you want to invest in. So that's the good stuff. We've given a little introduction to some of the nitty-gritty stuff on some tax consequences between a traditional versus a Roth and how you can invest using that money. So that's just a kind of a good little planting of the seed in your minds as far as what's the opportunity and what are the tax consequences, if there are any, with doing this, exercising this type of strategy. And I can see your next slide is talking about the non-recourse loan, which is what I used because I had the option back over 14 years ago when I wanted to invest and I didn't have any money outside of my retirement accounts. I had it inside my retirement accounts. So I was able to access it. And I did use the non-recourse loan because instead of just buying one outright in cash, I wanted to stretch, that's the word you use, stretch your money, with using a loan product to be able to invest into multiple properties, which is what I did. And I know what some of the rates are today. I'm going to blow people away when I actually tell them what my interest rate is. But I'll get to that a little bit later. So I'll let you take it over there, Seewing.
Please do so. Yeah, that segue, we're still, this presentation, still we talk about using the IRA to buy a rental property in the name of the IRA. So we're going to use an advanced strategy, which a lot of people are not privy to this, which is amazing. So, so we need to get the word out there to the real estate investing community out there. So the assumption is you're using your IRA to buy rental property. You do not have to buy your rental property in all cash, all IRA, dollar for dollar. You don't need to do that. What you can do, you can use a non-recourse loan. So what is a non-recourse loan? Non-recourse loan is something that can be you could leverage the IRA using a non-recourse loan. There's only one lender that I know of that can use this successfully, and I'll already show you. His name is Roger St. Pierre, which is right here. Okay, this is the only individual that I know that are willing to use the non-recourse lending to leverage your IRA. So contact the individual to do that. So with that said, when you there are some underwriting requirements which I will go over momentarily. I don't want to spend too much time on this strategy. Again, we are not a tax advisor, so the disclaimer is you need to consult your tax advisor to go over your unique situation. This presentation is for educational purposes only. So the non-recourse loan is great. You can leverage your IRA, and it's a non-recourse because the non-recourse lender, if you default on this loan, the lender can only go after the underlying asset. The lender cannot come after you as an individual. So that means you get some sort of a asset protection. I mean, all your personal assets are not subject to be litigated in case you default on this non-recourse loan. Will you clearly understand this, right? People out there, not you, Maureen.
Yeah, no, this is true. And there's a difference between the recourse loan and the non-recourse loan. The non-recourse loan, so the recourse loan is like, hey, you just put a little bit of money down, right? You put a little bit, 20% down, and the bank's going to finance the other 80%. A non-recourse is they want you to put more money up, right? Because they're looking at the level of risk. If they're going to lend you money, and they're going to lend you, let's call it 50%, they want you to come in with 50%, right? That's just less risk for them because you've got more capital in on the deal. You want to make sure that it's going to perform. And so, they're going to charge you more than, your conventional financing guys will. And that's okay. It's a market that is needed. There's not a lot of people out there that do it. I mean, Seewing, it's like, you've got one name, I've got one name. It's really, I've got two names now. It's hard to find people to lend in this type of space. And so there's a trade-off, you'll put 30 or 40% down. Some require 50% down out of your IRA funds. They'll fund the other 50%. And I don't know what your guys, Roger, what his interest rate is. Do you know that?
I believe the last time I checked, maybe 1 year ago, it was on 5.5%.
Okay, so yeah, you got it. He's offering. I mean, things have changed, right? So I don't know what my guy is either, because I haven't exercised this personly. But for you guys that are listening, for the investors that are listening, I want to tell you that I was, because now they're paid off, but I was paying 9.9% on this non-recourse loan. And some of you, if there was an audible, I would probably hear the gasp, like, oh my gosh, I would never do that. But guess what? That property cash flowed several $100s a month for me, which I just dumped right back on the note every single month. I didn't even keep the cash flow in there. I just put it back on the debt service, and I accelerated the payoff. So now that I've got 2 full properties paid in full, and then just dumping thousands of dollars into my account each month, right? It wouldn't have made sense if it was 9.9% and it was negative cash flow. It would still make sense if it was 9.9% and I had $100 cash flow, but I had 9.9% and I was making $300 a month cash flow roughly on each property. So in my mind, that made sense, right? So instead of getting hung up on the interest rate, I got caught up in but I was incentivized to go, I'm going to take this loan, this non-recourse loan that is nearly 10%, and I'm going to leverage it into 2 properties that are going to produce, about $600 a month in cash flow for my retirement account. That made sense to me. It didn't matter what the interest rate was. I just needed someone else to give me the other 50% so I could get the asset and then get all the other benefits that come with it. From the properties have appreciated, the rents have gone up. My cash flow is now really good because the property is paid off. Both of the properties are paid off. I'm just, each year, as the rents continue to escalate, I'll just put more money into that account. So that is why I did it. So the non-recourse loan if they're 5, 6, 7, 8%, even if they're 8%, is awesome. It's awesome. It's less than what I was paying when I started this, 14 years ago.
Yeah. So right now, it's a pretty decent rate for a non-recourse loan. Again, it's a very, very specialized strategy, and this lender, Roger St. Pierre, he's been doing it for a very, very long time. So I don't know any other non-recourse lender out there in the country except him. So it works. 5.5% the last time I checked. So he's just crunch the numbers. Investors need to consult with you and I, right, as a team, to determine, whether this kind of strategy makes sense to someone. But the non-recourse loan, the IRA is liable for the loan, not you, right? There's no recourse against you if you default. In case of a default, only the lender can seize the collateral, right? So that's very reassuring that, that a person that owns the IRA, that their personal asset are not being subject to be litigated if they use a non-recourse loan against the IRA, right? That's very reassuring, right? Don't you agree, Maureen?
Yeah, I mean, that is all of what you say there is true. And then just a couple other notes about the non-recourse. So they're a little bit different from the 30-year fixed mortgage. These are either 10 or 15-year fixed. They require a higher down payment. So instead of 20%, maybe 40, 50%. And then your interest rate's usually a little bit higher than what you can get conventionally. But nonetheless, it still gives you all these other benefits and protections. Yeah,
I believe I've done a number of these loans for our investors over the years. So I know what's going on. But one more thing is when an investor apply for a non-recourse loan to stretch their IRA to buy income property, the investor, they themselves do not need to get a credit score. They don't have to apply it's not under the name, it's under the IRA's name. So the individual holding the IRA do not need to go through the traditional loan underwriting. You don't need to apply for credit to get your FICO score out there or or you don't have to submit your W-2. It's not a regular conventional loan underwriting.
Right.
The IRA is underwriting the loan. So the non-recourse lender look at the collateral of the IRA. If it is 30, 40, 50%, the loan underwriting is against the IRA's equity. It have nothing got to do with your personal guarantees. It's not a personal guarantee. You don't have to, I say it again, you do not need to apply for credit. You need, the non-recourse lender is not going to run a credit history on you as a person, right?
They lend based on the performance of the asset. It's asset-based lending.
Exactly. Your personal information, your social security number, your date of birth, your credit score, whatever your credit score, have nothing got to do with the non-recourse loan using the IRA. I want to make this clear distinction because there's still a lot of confusion out there, right?
Yep.
Okay, with that said, again, we only have like less than 10 minutes for this presentation. So let's keep it high level, keep it simple and all that stuff. So we're going to use a real, once again, we're going to use a real case example. No, not this one. Oh, did I do a, oh, I didn't do the non-recourse loan calculation. Oh my goodness.
Oh my gosh. So that means we're to be continued. We'll make sure that we get one for you guys and show you what the numbers look like, because you want to see what the cash flow, the monthly cash flow would look like with, you know.
Never mind. So sorry to interrupt you. I did it. I'm sorry. He's right here.
Oh, there it is. Yep. Yeah, I see it.
Right
96,000. Yep. Got it.
So sorry to interrupt you, but I did do the non-recourse loan pro forma calculation. So with that in mind, let's go over it. Okay. Let's go over the same property, right? The previous example, as you can see, you have to use the full IRA purchase to buy this price of this property. You have to use at least 192K of the IRA plus additional cash reserve for the IRA, right? It's a full purchase, no problem. No recourse loan needed, right? It's a dollar for dollar purchase. Nothing wrong with that, right? However, if you want to stretch your money, if you want to buy more properties within your IRA, as we said before, you need to leverage a non-recourse loan. So same property, Rossville, Georgia, same price, 192. So the underwriting requirement for this non-recourse loan is 40%. I'm going to use 50% down payment for the sake of discussion, right? So 50% of the money going to use by the IRA, 50% of times 192. So your IRA, total IRA out of pocket to buy this property is 100,000. Does that make sense? So the non-recourse lender, in this case, the lender we just talked about, will underwrite the other 50% of the loan, non-recourse loan against the IRA. So in this case, 96,000. Does it make sense? Around 96,000. 50% loan to value, right? So the collateral is sufficient. Underwriting is great at 5.5%. Is not a 30-year fixed rate. Is a like you said, it's a 10-year term, whatever. You know, a little bit. Non-recourse loan is not a Fannie Mae lending guideline. Is a non-qualified loan, right? Is a private loan. So therefore it's higher risk, and interest rate is higher, and the rate in terms of not as ideal as you normally get if you do a conventional lending. Does that make sense?
Yeah.
But the number plays out. Instead of using 192 IRA to buy 192 property, you're only using half of the IRA to leverage against the price of the property, 192. So let's look at the numbers. Same rent, same gross rent, 1450. The only difference is you're having the additional mortgage payment from non-recourse lending. The $96,000 non-recourse loan at 5.5% equal monthly payment around $540. So you add $540 into the debt service, add it to the your monthly property taxes, insurance, property management fee, whatever, vacancy and maintenance. At the end of the day, you still have $490 of net monthly cash flow tax deferral from your IRA as a result of the leverage. You can reinvest this $490 of IRA non-taxable cash flow reinvested back inside the bucket, gross tax deferral. Instead of getting $1,000 a monthly cash flow from a full IRA purchase of this property, you're using a powered non-recourse loan. You have used half of your IRA, still get a good cash flow, $500 per month, tax-free. Does it make sense?
It makes a lot of sense. I mean, to me, because I know that I've done it, and some people, if you're thinking, well, how many, if I do multiple properties in there, isn't that a lot to manage? No, because you can literally take, the monthly mortgage payment that your IRA needs to make, not you personally, but your IRA that you own. You can set it up on automatic bill pay, right? I set it up for the terms, the length of the loan. It was all, I always made sure the rent check made it in there. There was enough money to cover the mortgage payment. And then I added extra to the principal payment so I could accelerate it faster.
Oh, as a matter of fact, I was going to discuss about that. Well, you beat me to it, Maureen, once again. So here's the deal. Now, let's assume you're way, way before the age 59 and a half. This positive cash flow, I mean, it's not like you're going to spend this money. You can't because you have not reached age 59 and a half. Anyway, you're not going to liquidate anything. So what you should do, you can apply, you can pay down your non-recourse loan. You could apply this monthly cash flow, $490 pay it down on a monthly basis to pay down this loan of $96,000 in about 7 years, 10 years, right?
Which is what I did. It's exactly what I did.
You don't need the cash flow. You need the cash flow upon retirement, age 59 and a half or older, right? So if you can use this extra monthly net cash flow from an IRA, you could pay one principal per month, accelerate the debt, principal pay down. You can pay off the non-recourse loan in about 7 to 10 years, maybe, right? Maybe slightly longer. After that time, you have no more debt, no more non-recourse loan mortgage inside your IRA, so you can capture $1,000 of cash flow as if you purchase with a full cash IRA purchase initially, as in this example earlier. And the rules still apply down the road, right? Keep on, hold this property long term, and then age 59 and a half, you can liquidate the monthly income for retirement purposes and don't ever need to sell your IRA portfolio because your IRA portfolio from this house grows over time. So you just withdraw the monthly income at retirement forever for the rest of your life. And then when we die, guess what? Step up in basis. Your beneficiary is not going to pay any taxes on the growth of your property over many, many decades, tax-free.
It's a good strategy. I personally use it.
Yep, no need to file your tax return during the accumulation phase of this investment strategy until you withdraw the money at age 59 and a half. The amount of the withdrawal is subject to ordinary taxation at age 59 and a half, which is hopefully at a lower tax bracket because you probably are not working full-time anymore, or maybe not working at all. You'll have subject to a very, very low tax bracket that you can apply towards your monthly retirement withdrawal. Does that make sense?
Yes, it does. Well done, Seewing.